Welcome to the best investment writing, your gateway to the minds of the world's most respected investors. Join us as they unveil the insights gleaned from their tireless research, providing you with invaluable perspectives to enhance your own investment journey.
All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Hi, I'm Rob Campbell, Institutional Portfolio Manager at Mawer Investment Management. Mawer is an independent, employee-owned investment firm based in Calgary, Alberta, specializing in equity and fixed income portfolios. For over half a century, we've helped institutional and individual clients successfully navigate shifting market landscapes and many economic cycles using our disciplined, bottom-up investment approach. Be boring, make money. To learn more, you can find us at www.mawer.com. That's MAWER.com. And now, a piece we published back in January on our Art of Boring blog, Dead Reckoning, Investing Lessons from the High Seas. Few places on Earth are as perilous as the seas off Cape Horn. Waves in the Southern Ocean build uninterrupted over 13,000 kilometers before being squeezed into the narrow body of water between the tip of South America and the Antarctic Peninsula, known as the Drake Passage. These are the most powerful currents on Earth. More than 4 billion cubic feet of water per second. That's 600 times the outflow of the Amazon River. To boot, the confluence of the Atlantic and Pacific Oceans brews ferocious storms, towering waves, and regular hurricane-force winds. Known as the Sailor's Graveyard, Herman Melville likened the journey around the Cape to the descent into hell from Dante's Inferno. Nearby landmarks bear sinister names: Desolation Bay, Deceit Rocks, and countless islands named for ships that have sunk or run aground over the centuries. I recently read an account of one of these ill-fated voyages, David Grand's The Wager, a tale of shipwreck, mutiny, and murder. Besides the driving rain, howling winds, colossal waves, and forceful currents, not to mention the onset of scurvy, the crew aboard the HMS Wager in 1741, like all other seafarers of the age, had to contend with the additional challenge of never reliably knowing where they were. Sure, there were decent navigational maps at the time, and measuring one's latitude could be done quite accurately by using the sun or the stars. But longitude, a ship's position east or west, was much more difficult. The main reason for this was the lack of a reliable clock. Before the advent of better tools, to determine longitude on the open ocean, you'd ideally compare the local time of your position at sea with the time at a fixed reference point. For example, the port you set out from or the prime meridian. Each hour of difference corresponds to 15 degrees of longitude. But timepieces such as pendulum clocks were highly ineffective at sea due to the constant motion of the ship, not to mention changes in temperature and humidity. And this meant real consequences. Being inaccurate at Cape Horn by even 30 minutes translates into being nearly 500 kilometers off course. Instead, seafarers relied on a technique called dead reckoning. The concept was theoretically simple, yet fraught with peril. Chart your position based on a known starting point, your speed and your heading. Use a sand hourglass to estimate time, and a long, knotted rope dropped overboard to estimate speed. The impact of wind and currents? Adjust using your intuition. The HMS Wager entered the Drake Passage in 1741 and battled storms for an entire month. Its navigators, using dead reckoning, eventually believed they made it safely through and plotted a course north, only to realize they were still smack in the middle and barely avoided running aground. A month later, further up the coast of Chile, the limitations of dead reckoning proved fatal for the Wager. Despite estimating a position 250 kilometers offshore to the west, the ship suddenly wrecked into the Patagonian coastline along the Golfo de Peñas, the Gulf of Pain. Dead reckoning indeed. In many ways, investing is a lot like navigating Cape Horn with dead reckoning. The waters of the market are choppy and unpredictable. Investors, like sailors, must grapple with incomplete information, unexpected shifts, and the ever-present possibility of being wildly off course. The currents, momentum, can be powerful. PE multiples, EV to EBITDA ratios, earning expectations, leading economic indicators, discounted cash flow models. all dead reckoning. Now, does this mean that successful investing is as futile as the HMS Wager's ill-fated journey? We certainly don't believe so. The following article will illustrate several ideations and tools investors can incorporate into their processes to navigate the choppy, mercurial waters of long-term investing. Part 1, Investing Without a Compass. And it begins with a quote from Seneca. If a man does not know to what port he is steering, no wind is favorable to him. In the 1950s, Dr. William Deming performed a simple experiment. He dropped a marble through a funnel onto a target below with the goal to have the marble come to rest at the center of the bullseye. Deming compared various strategies for improving accuracy, and he found that adjusting the position of the funnel after every drop, in other words, reacting immediately to every error, led to an increase in variability and worsened accuracy over time. The best results came from maintaining a consistent approach and making adjustments only after methodically observing patterns of bias over many trials. We and many others have written at length with regards to the importance of having a clear, theoretically sound investment philosophy and a systematic investment process. Just like on the open ocean, they provide North Stars in an uncertain and sometimes hostile environment, frameworks for ensuring focus, discipline, rational thinking, and anchoring with appropriate context. As an example, one of the foundational underpinnings of our approach to risk management is the clarity that the primary risk we're seeking to guard against is the permanent impairment of capital, an absolute metric. By contrast, when British shipping company White Star Line developed a new class of ocean liners in the early 1900s, it had relative goals in mind. Instead of competing on speed, the shipping line opted to explicitly outdo its rivals on size and luxury. Bigger, more lavish, and with the names to match: Olympic, Britannic, and Titanic. Even safety precautions were viewed through a relative lens. Though Titanic only had enough life vessels for roughly 1/3 of its total passenger capacity, this was a larger number relative to that required by maritime safety regulations at the time, providing the illusion of safety. And besides, any more lifeboats would clutter the deck and run contrary to the goal of relative opulence. In our view, investors who worry too much about relative risk or relative performance in the short run risk making myopic decisions that are suboptimal over the long run, both for absolute and for relative risk-adjusted returns. Part 2, Dead Reckoning and the Danger of Extrapolating Trends. Mark Twain said, "It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so." Dead Reckoning relied heavily on assumptions about speed and direction. But what if the wind shifts or a current pulls you off course? Extrapolating inaccuracies too far over time and space can be treacherous. Golfers know this. On the green, in order to maximize accuracy, a putter's face angle at impact should be perfectly square to the intended line. For putts less than 4 feet in length, the ball will generally still go in even if the putter face is open or closed by plus or minus 2 degrees at impact. And if this doesn't sound like much, don't be so hard on yourself the next time you miss a gimme, because even PGA Tour professionals miss 12% of 4-foot putts. But at 15 feet, the margin for error narrows. A mere half-degree face angle difference is too much to sink a 15-foot putt. Small errors magnify over time and distance. Over most of the last 3 decades, the German economy benefited from a straightforward business model, and admittedly, a gross simplification. Sell goods to China, get cheap energy from Russia, and rely on the US for defense. The risks inherent in those decisions seem obvious today given how geopolitics have evolved, but the underlying vulnerabilities have been present for 30 years, even if unrealized. What's more, they've grown over time given the compounding of underinvestment in domestic skills, supply chains, and capabilities. Germany is now grappling to come to terms with the notion that globalization might not continue unabated. What assumptions have you made that your investment portfolio is heavily reliant upon, and that might turn out to be false? Part 3, Stories. Getting marooned by a market narrative. And this begins with a quotation from our chief investment officer, Christian Deckert. "You can close your eyes and cross a 4-lane highway, but even if you get to the other side, you're still an idiot." Closely connected to the extrapolation of a trend, in fact, deeply at its root, is our propensity as human beings to be profoundly drawn to stories. Why? Simply put, evolution has rewarded survival over optimal decision making. Stories capitalize on our need to make snap judgments about cause and effect relationships for survival. A rustling in the bush nearby? Far safer to run for fear of a predator than be curious given the asymmetry of payoffs. As our ability to communicate through language developed, generational knowledge sharing via oral tradition further embedded cognitive shortcuts by mirroring information with emotion. From an anthropological perspective, storytelling fostered social cohesion in a group, enhancing trust and collaboration. Our ability to unite individuals under a shared narrative has played a critical role in the development of larger, more complex societies where myths and stories serve as frameworks for social norms and collective goals. Reflecting on our experience with storytelling through COVID-19 is instructive. Consider the now ubiquitous Zoom, whose stock price increased nearly sevenfold in the first year of the pandemic with the shift to working from home. Even though the narrative was directionally correct, many firms now have more flexible work from home policies than prior to 2020, the hype has subsequently been punished, with the stock down approximately 85% since its peak. The investment team at Voltava Fund recently shared a thought-provoking chart in a letter to shareholders. You can see this chart in the paper, but it effectively lists the 10 largest companies in the world for each of the past 5 decades. To borrow from Voltava's excellent analysis, these biggest companies are effective representations of the prevailing narratives during each epoch. American exceptionalism and energy dominance in the early 80s, the rise of Japanese economic superiority by 1990, the dot-com era and the boundless potential of the internet in 2000, the bullishness around Chinese growth along with the associated demand for commodities in 2010, and the current Magnificent Seven. Soberingly, in each of the past 4 decades, the consensus narrative was a rather poor forecaster of future returns. For example, the 8 Japanese companies that began the 1990s at the top of the market cap spectrum posted an average annualized return of minus 3% in the 1990s, vastly trailing the MSCI World ex-Japan Index, which had an annualized return of plus 16% over the same decade. Microsoft, Cisco, Intel, Deutsche Telekom, and NTT took many years to recover from their ensuing drawdowns post-dot-com bubble, if they did at all. Cisco, in particular, is a fascinating cautionary tale. The narrative that led to its outsized valuation in 2000 was largely based on the notion that its products would lay the infrastructure to power the then-emergent internet for decades to come. Imagine the potential. Fast forward 25 years, and despite incredible advances in technology, the explosion of online collaboration, and the company continuing to dominate network hardware, Cisco claims that its customers include 99% of the world's largest companies today, the stock still trades below its peak. What's more, a worthwhile paper by AQR's Cliff Asness entitled The Less Efficient Market Hypothesis postulates that markets have become increasingly less efficient over the past 30 years. One exhibit behind this assertion is the price-to-book ratio of the most expensive 30% of US stocks compared to the PB of the bottom 30%. And this ratio is currently close to its all-time high. Asness goes on to hypothesize that the widely accepted premise that technology has made markets more efficient, think ever-expanding datasets, instantaneous delivery, machine learning, is actually false. Instead, these technological improvements have merely served as echo chambers, either by boosting storytelling via social media and their associated algorithms, by increasing short-term impulses with the gamification of investing, think retail trading platforms and zero DTE options that expire same day, or, and this part was not mentioned by Asness, because algorithmic trading models are trained on the past, thereby fueling momentum, pattern recognition, and regressions which may not be representative of the future. Asness's conclusion, with some paraphrasing, it should be more lucrative for those who can stick to a sensible investment strategy that cares about valuation over the long term, but also harder to stick with it. The periods of underperformance will be more severe and last longer. Let's go back to Voltava's exhibit. Perhaps this time is different. Perhaps diversification is a relic of a more prudent past. Perhaps the build-out of AI infrastructure is unlike CapEx cycles in more traditional industries or unlike networking equipment and Cisco. As the chart below suggests, and I'll describe it in a moment, perhaps a company's ability to generate positive cash flows is no longer relevant. Perhaps human intelligence has finally reached a point where we're finally able to overcome our behavioral biases and act without emotion. The base rates suggest otherwise. And part 3 ends with that chart that asks, what stories are US small cap investors telling themselves today? A visual from JP Morgan showing that the proportion of small cap companies with negative earnings has risen substantially and currently sits around 45%. Part 4, triangulation. From Robert Evans, there are 3 sides to every story: your side, my side, and the truth. Unlike Dead Reckoning, modern navigation combines multiple tools in order to triangulate for accuracy: GPS, radar, sonar. And likewise, investors should attempt to combine multiple inputs and viewpoints in conducting their research. In a complex problem like investing, an important starting point is internal. Are members of your team cognitively diverse? Meaning, do they have different ways of thinking and tackling problems, either innately or as a function of their education and life experiences? Or does your investment team merely serve as an echo chamber promoting a narrow perspective? And further, does your decision-making environment take advantage of the diversity of thought available? After all, diversity of thought within a team is meaningless unless individuals have the humility to hold their stories lightly, to be open and curious to ideas that might challenge their own, and to engage in respectful debate. In a paper we published a few years ago entitled How to Make Good Decisions, Mawer portfolio manager Paul Miraz outlined a fantastic example of what this looks like in practice. Debate on the merits of Tencent's investment case have included team members with the following backgrounds: a lawyer whose academic focus emphasized the nature of property rights and the role of government in maintaining and shaping rules and regulations. This is material for Tencent, given the VIE structure through which the stock is listed. There's an entrepreneur with a history of incorporating companies and navigating the impact of associated regulations. Another entrepreneur who launched an internet company in university with a first-hand appreciation for the merits of a virtual business model. An investor who grew up in China, is a daily user of Tencent's WeChat platform, and plays many of Tencent's online games. 3 of these 4 investors have lived in Asia. 2 of the 4 experienced the dot-com bubble and subsequent crash. Now, given that Tencent's investment case rests on property rights in China, a robust valuation, a new age, and a scalable business model, this combination of viewpoints creates a better information collage on which to base investment decisions. Diverse perspectives must be sought externally as well. My colleague John Wilson wrote on this topic several years ago, and he began with a quotation from legendary investor Philip Fisher. Go to 5 companies in an industry, ask each of them intelligent questions about the points of strength and weakness of the other 4, and 9 times out of 10, a surprisingly detailed and accurate picture of all 5 will emerge. At Mawer, collecting scuttlebutt is a dedicated part of our process. In our ongoing research into a multinational cosmetics company, we've spoken with management, sell-side analysts, ex-employees, rival multinationals, and domestic competitors in key markets, not to mention being daily users of the products ourselves. One of the key areas of debate is the extent to which recent weakness in China is tied to increasing competition, which may be of graver structural concern, versus broader macro factors. And while none of these perspectives gives us the quote-unquote answer, the process of collecting scuttlebutt provides a valuable mosaic, insight into corporate culture from multiple angles, and ultimately a finer sense for KPIs to watch going forward. Building out a cognitively diverse team, ensuring that intelligent ideas are voiced and heard, and collecting useful, relevant scuttlebutt requires significant investment in time and energy. But they all increase the likelihood of sound, well-informed decision-making. Part 5, margin of safety. Never skirt too close to the rocks. This section begins with a famous quotation attributed to Keynes. It is better to be approximately right than precisely wrong. Finally, we come to the importance of having a margin of safety. Cognizant of the limitations of Dead Reckoning, sailors knew to give Cape Horn a wide berth. Likewise, investors should account for the inevitable unknowns. Buying with a margin of safety, at a price below a company's intrinsic value, provides room to absorb errors in judgment or unexpected squalls. At Mawer, one of the ways we respect the inherent imprecision in determining intrinsic value is by embracing the sheer uncertainty of the endeavor. Instead of chasing the illusion of exactitude, all of our discounted cash flow models are stochastic, powered by Monte Carlo simulation to incorporate sensitivity analysis. And the result, neither a single price target nor a simplistic bull-bear base case, but rather a continuum, a probability distribution of possible outcomes. Of course, We're not blind to the fact that the inputs into our DCFs may be prone to bias and error, but the process of building these models, continually seeing how variability from a given input influences the overall distribution, instills humility and discipline, a respect for the mutability of intrinsic value, and a consistent framework for charting a margin of safety. Price may be the most obvious margin of safety, but often overlooked is business model strength. Now consider 3 hypothetical companies. We've got Abigail's Average Apples, a lower quality business that earns a return on capital equal to its cost of capital. There's Betsy's Better Blueberries, which exhibits a decent degree of wealth creation and earns a return on capital 5% greater than its cost of capital. And then finally, Carla's Champion Cranberries, which boasts substantial and sustainable competitive advantages, allowing it to earn a return on capital 15% greater than its cost of capital. Now, assuming each of these companies starts with an intrinsic value of $100, there's a chart in the paper that shows what each company should be worth over various time horizons, with Abigail's Average Apples staying constant at $100 and the other 2 companies increasing in value over time. But what if you overpaid for each of these investments? What if you purchased each of them for $130 in year 0? In other words, 30% above intrinsic value. Well, there's another chart in the paper that shows the hypothetical returns for each of these investments over the same horizons. Because the intrinsic value of Abigail's Average Apples stays at $100, buying it for $130 locks in a negative return over all time horizons. Overpaying by 30% in year 0 for Betsy's Better Blueberries results in negative returns through year 5, but ekes out a positive 2.3% annualized return by year 10 due to its wealth creation. By contrast, whereas Carla's Champion Cranberries has negative returns over time horizons of 1 and 2 years, the higher level of wealth creation results in a 5.4% annualized return above 2 years and a 12% annualized return over 10 years. In all scenarios except the shortest of time horizons, the strength of the high-quality business model provides that margin of safety due to its wealth creation. Now, this is not to suggest that an appropriate margin of safety on valuation shouldn't be overlooked, and this is a really critical point. The greater your valuation error, the longer those competitive advantages and your assumptions regarding wealth creation need to persist into the future for the business model to overcome the valuation error. After all, as Columbia Business School's Bruce Greenwald once remarked, in the long run, everything is a toaster. In expectations investing, Michael Mauboussin and Alfred Rappaport recommend tackling the problem of margin of safety backwards. Assume the current stock price is a company's intrinsic value and back out what assumptions need to be made and over what time horizon to justify the current price, comparing them to base rates. Yet another helpful method of triangulation, both on the price and on the business model. All right, tying it all together, the investor's sextant. Much like navigating the seas with dead reckoning, investing is an exercise in managing uncertainty. The ocean of markets is vast and unpredictable. Our tools and guideposts, while predicated on sound principles, often unreliable in practice. But by avoiding the temptation to extrapolate trends blindly, being mindful of stories, triangulating information, and always leaving a margin of safety, investors can chart a course toward long-term success. In investing, as on the high seas, it's better to steer cautiously than to end up dashed on the rocks of overconfidence. Plot your course wisely.
If you enjoy the show, be sure to leave us a rating and a review on your favorite platform. You can read investment research like you heard today by subscribing to The Idea Farm's free weekly e-newsletter at theideafarm.com. Thanks for listening, friends, and good investing.